Welcome to the Macro Microeconomic and Financial Commentary. We are your hosts from the Macro Micro Research Team. It's June 2nd, 2025. Today, we're doing a deep dive into what we're calling Taco Tuesday every day. Basically, how tariff strategies are really shaping global markets and economic flows right now.
Exactly. And we're going to break this down into three sort of critical themes for you to get a handle on the current landscape. First, we'll dig into this Wall Street idea, the taco trade. That's TACO, for Trump always chickens out.
Right.
We need to explore what that really means for how tariffs are being used today.
Right. And second, we'll look at three fundamental pillars that we think are, propping up the U.S. dollar for the second half of 2025, especially given all the recent choppiness and, the worries about U.S. debt.
And third, we'll analyze how India seems to be strategically positioned, maybe emerging as a key beneficiary from all these ongoing trade tensions and supply chain shifts we're seeing. So let's maybe start with the tariff landscape itself. Where do things stand?
Okay, yeah. The legal front is definitely a key place to begin. There was that recent federal court ruling, against using the IEPA, that's the International Emergency Economic Powers Act, against using that specific act for tariffs on fentanyl from China and for some reciprocal duties. The court basically said, look, this might be overstepping presidential authority.
But it's crucial for you, the listener, to remember that ruling is being appealed, right? So those specific IEPA tariffs, they're actually still in effect for now. And maybe even more importantly, that legal challenge doesn't touch the big Section 232 tariffs, steel, aluminum, potentially autos down the line. Those are completely separate, legally speaking, and still intact.
Absolutely. And far from backing down, the administration's actually talked about doubling those Section 232 steel and aluminum tariffs, up to 50%. So that signals a pretty hard line using tools that aren't facing these specific legal hurdles. Plus, there are other tools in the toolbox, like Section 122 of the 74 Trade Act, that allows for temporary, 15% across the board tariffs.
Right. So this mix of different legal authorities, some under challenge, some not, it gives a lot of flexibility, doesn't it, to keep applying pressure, especially, in talks with China. And that context is really important when you look at how markets reacted, say, back in May. The resilience we saw.
Yeah. After that initial shock when the tariffs were announced on April 2nd, markets, they mostly clawed back their losses through May. And that kind of behavior suggests maybe investors are starting to think April 2nd was the peak risk point for this whole cycle, which I guess brings us to that taco trade idea you mentioned.
Exactly. The taco trade Trump always chickens out. It's Wall Street shorthand, basically, for this pattern people think they see. Big tariff threats get announced, markets react, and then the threats often get scaled back or tweaked. It suggests the main goal isn't always just punishment, but maybe leverage, negotiation.
And we saw some pretty clear examples of that pattern just last month in May, didn't we? It kind of supports that taco view, like the US-UK deal on May 9th. It eased some tariffs, sure, but it wasn't free. It came alongside a huge $10 billion Boeing order from the UK, plus, better access for U.S. beef and ethanol exports.
So tariffs used as a bargaining chip there to get something concrete in return.
Precisely.
And then there was that interesting timing around Saudi Arabia. Trump approved their big purchase, 18,000 NVIDIA servers, a major U.S. tech sale. And almost right after, on May 13th, China kind of unexpectedly cut tariffs on some goods down from, 145% to 50%?
Right. Now, look, correlation isn't causation, obviously, but the timing fits the pattern, doesn't it? It suggests these tariff moves might be linked strategically to wider negotiations, opening markets, securing deals.
Yeah, it paints a picture where tariffs aren't just blunt instruments, but more like dynamic tools in a negotiation strategy used to get concessions or open doors.
And maybe that helps explain why markets seem to be getting a bit more, accustomed to the initial announcements, viewing them as opening bids rather than the final word. Okay,
so that's the tariff side. Let's shift gears now to our second theme, the dollar. There's been a lot of anxiety there, right, about U.S. debt, the dollar's recent volatility.
Yeah, absolutely. You've definitely seen the headlines focusing on the U.S. debt hitting, over $36 trillion now. And Moody's put out that warning after Congress was debating Treasury issuance for the second half. But look, while the debt is obviously a huge long-term issue, our analysis kind of suggests that specific Moody's warning tied to the issuance debate, it feels maybe more symbolic about fiscal discipline than an immediate threat to the dollar's value, especially when you factor in potential tariff revenue.
That's an interesting point. And there's that Yale Budget Lab research you flagged. Their estimate suggested a 10% reciprocal tariff, so U.S. puts on 10%, partners respond with 10%. That could potentially offset something like 80% of the deficit increase from that big $3 trillion House bill over a decade.
So it suggests tariff money is at least being considered in those deficit management talks.
Right. But maybe the more immediate fiscal headache for the U.S. isn't just the deficit size, but the cost of servicing all that debt. It's huge.
Oh, absolutely massive. Around $880 billion a year just on interest payments. That makes Fed policy just incredibly critical. We estimate, even a small 25 basis point rate cut, just 0.25%, that could potentially shave about $27 billion off the annual interest bill. So what the Fed does with rates, with QT, it's paramount.
And the Fed, well, they stayed put in May, kind of wait and see. But we do think there's potential for cuts or maybe at least pausing quantitative tightening QT later this year in the second half. Partly because there are signs growth might be slowing a bit,
Yeah.
That inventory restocking that boosted things earlier, that seems to be fading.
Which leads right into all that chatter about a deliberate dollar devaluation, right?
Yeah.
People jokingly call it a Mar-a-Lago Accord, like the Plaza Accord back in '85. And you can see why people talk about it. May saw big gains against the dollar almost everywhere. The Taiwan dollar surged like 8.4%. The main USD index dipped below 100 a couple of times. It definitely fueled that conversation.
But, the dollar's role today is so different from the 1980s. You have huge amounts of U.S. assets held overseas now by foreign investors, central banks. If the U.S. deliberately tried to weaken the dollar significantly and sustainably, that would hit those foreign holders hard, create massive losses.
Yeah, that could cause serious instability in global markets, couldn't it? And it would undermine the very thing that gives the U.S. so much power, the global demand for dollar assets, its financial dominance.
Exactly. So, a weaker dollar might look good for the trade deficit on paper, but actually engineering a big depreciation, it would likely damage America's financial hegemony, its central role.
So in the current policy calculus, preserving that hegemony, that central role, probably outweighs just trying to fix the trade deficit numbers.
Precisely. That strategic priority makes a coordinated, deliberate, big dollar devaluation pretty much unviable structurally in today's global system.
Okay, so despite that underlying strength and strategic need, the period since April 2nd, since those tariff announcements, it really has felt like a short-term confidence crisis for the dollar, hasn't it?
Definitely. We saw pretty big outflows across different markets. Some people called it a triple kill, hitting stocks, currencies, and bonds all at once. And then those renewed tariff threats, like 50% on the EU potentially from June 1st, talk of 25% on non-US iPhones, that pushed the dollar back under 100 again recently, even after those deals in May.
It feels a bit like 2018, 2019 again, doesn't it? That kind of volatility, the policy uncertainty, this cycle of threats, then partial walkbacks. It seems to be damaging sentiment structurally. It makes it hard to rebuild short-term confidence quickly.
Yeah, and you see it in the market positioning data. Those net speculated long bets on the dollar, combined with euro hedges, they've collapsed back to where they were in early 2024, shows confidence is down. And the dollar breaking 100 twice since April, that underscores the vulnerability. Sentiment is definitely shaky because of this unpredictable policy stuff. Plus, you had Asian economies rushing exports in H1, which also dampened dollar demand short term.
Okay, so given all those challenges, the confidence wobble, why do our sources still point towards dollar resilience in the second half? This is where those three pillars you mentioned come in.
Right. Pillar number one is really about economic differentials. The U.S. economy, heavily based on services, seems, better insulated than economies reliant on global manufacturing. Manufacturing worldwide looks vulnerable to inventory pileups from tariffs and then maybe painful destocking later this year. The U.S. structure is just less exposed to that specific headwind.
Makes sense. In pillar two.
Pillar two is asymmetric monetary policy. We think overseas central banks, places like Europe, probably face more pressure to cut rates aggressively, partly because of deflationary forces from tariffs hitting demand. But in the U.S., the job market is still relatively stable. That limits how much or how quickly the Fed might ease compared to others.
So the rate gap widens, favoring the dollar.
That's the idea. The implied interest rate differential between the U.S. and, say, Europe widens out, supporting the dollar. Plus, there's a technical factor,
Yeah.
the Treasury General account, the TGA. When they rebuild that cash balance, likely in Q3 after the debt ceiling stuff is sorted, it effectively pulls liquidity out of the banking system. That provides a kind of technical tightening for dollar funding.
Okay, economic differences, monetary policy divergence. What's the third pillar?
The third pillar goes back to those strategic imperatives we discussed, and just the practical difficulties of doing a Plaza Accord-style devaluation today. Like we said, dollar holdings are spread all over the world now. You need massive cooperation. And China, a huge holder and strategic competitor. They're keeping their own currency, the RMB, intentionally weak. They're not going to cooperate on weakening the dollar, are they?
Not likely, no.
So these strategic realities, the execution problems, they reinforce the idea that keeping the dollar dominant is the main goal. These structural factors underpin why we expect the dollar to stabilize and show resilience in H2, even if trade headlines keep causing short-term bumps.
All right. That brings us to our third major theme, the beneficiary. It seems India is really emerging here.
Yeah, the signs are pretty clear, both in trade flows and investment. Now, the India-Pakistan ceasefire in May certainly helped sentiment, reducing regional risk. But the bigger story seems to be trade diversion. Indian exports to the U.S. just exploded, up over 30% year-on-year in Q1 2025, and still flying high at 27% growth in April.
And a lot of that is down to U.S. companies building inventory, right? Partly because of that 20% fentanyl tariff on China, but also because finding alternatives in places like Vietnam, it's limited. So India is just well-positioned geographically and economically to scoop up a lot of that diverted trade.
Absolutely. And the Apple example the sources highlight is, well, pretty stunning. Foxconn's iPhone exports from India hit $1.3 billion in March alone. That single month matched the entire previous 2 months combined, January and February.
Wow.
Yeah. And by March, U.S. smartphone imports from India were almost level with imports from China.
Yeah.
That's a massive, rapid shift in a really high-value supply chain.
And Apple actually naming India its main U.S. supply source in Q2, that signals it's not just temporary, right? It feels like a fundamental restructuring. Our analysis suggests India's production could potentially grow 1.1 times by 2026 just to meet U.S. and Indian demand combined. That points to a really structural, lasting shift in supply chain geography.
Yeah. And critically, India's domestic economy seems strong enough to support this opportunity. Q1 GDP bounced back nicely, 7.4%, beating forecasts. And the key number, gross fixed capital formation, basically, investment in infrastructure, factories that soared to 9.4% growth. Huge jump from 5.2%. That shows the investment is happening to build the capacity needed.
The government spending backs that up too, doesn't it? Central government capital spending up over 33% year-on-year in Q1 and a record 61% jump in April alone. That shows real commitment to building the infrastructure needed to integrate more into these global supply chains.
India also had, and in some ways still retains, a kind of structural tariff advantage compared to China, especially looking back at the peak tariff periods. Even if consumer electronics tariffs may be leveled out at 10% more recently, India's existing infrastructure, combined with new investment commitments like Foxconn's $1.5 billion, HP working with Dixon, it helps them keep and even grow their role.
And that big chunk of the budget, 23.1%, allocated to capital spending in India for 2025-26. That really signals they're playing a long game here, aiming for structural manufacturing gains, not just riding a temporary wave.
Exactly. And you see it in their own manufacturing data, too. The manufacturing PMI actually strengthened in March and April, kind of defying the global slowdown trend driven by tariffs elsewhere. Value-added growth also picked up. Things seem to be clicking domestically.
Plus, solid private consumption growth, over 7% last fiscal year. That gives a nice domestic cushion, doesn't it? Provides stability alongside the export boom.
So you put it all together.
Yeah.
Lower risk perception on trade policy, the structural advantages, the investment coming in, the resilient domestic economy. India looks very well positioned. It's this convergence of trade diversion, investment, and domestic recovery that supports the view that India could be set for sustained market outperformance because of these structural shifts.
Okay, so to help you, our listeners, track how these complex pieces are moving, there are a few key data points out this week that will really test this whole framework. U.S. manufacturing PMIs are actually due out today, June 2nd. The expectation is still contraction, around 49.0. If that number comes in weaker, suggesting the slowdown is accelerating, that could definitely raise concerns about broader economic momentum.
Then on June 5th, we get the Eurozone interest rate decision. Everyone's pretty much expecting a 25 basis point cut there. Recent data on wages slowing and inflation stable seems to support that. A cut would obviously reinforce those monetary policy differential dynamics we talked about, the ones favoring the dollar.
And then Friday, June 6th is the big one, U.S. jobs data. The forecast for April non-farm payrolls is for a slowdown, maybe 130,000 jobs added. If that number misses significantly to the downside, that could put pressure back on the dollar and really fuel worries about U.S. economic strength. It's a key test for our resilience thesis.
Yeah, those releases this week will give us some critical real-time reads on manufacturing health, policy divergence, and U.S. momentum. We'll be watching closely to see how they fit the picture we've painted today.
So as we wrap up this deep dive based on the source material, a few key takeaways for you navigating the second half of 2025. First, that taco trade idea suggests tariffs are being used more as negotiating tools than fixed barriers, which helps explain why markets have shown some resilience despite all the noise.
Second, the dollar. Yes, it's faced short-term volatility, a confidence test since April, but its underlying resilience for H2 seems supported by those three pillars: better economic structure, diverging monetary policy, and the strategic need to maintain dollar hegemony.
And third, India really does appear to be emerging as a major structural winner from all this trade tension, thanks to trade diversion, big investments, and solid fundamentals. That points to potential sustained outperformance there.
And we just reiterate those three critical areas to keep monitoring. Corporate inventory levels, a key signal for manufacturing risks, developments around treasury issuance that impacts liquidity, and watching the Japanese yen and carry trade risks, especially if we see any major moves in long-term Japanese government bond yields. Those are your leading indicators for volatility.
Thank you for joining us for this deep dive on the macro-microeconomic and financial commentary. We are your hosts from the macro-micro research team. We'll keep tracking these developments and what they mean for markets.
And perhaps a final thought for you to consider. Is this current era, the strategic use of tariffs and the supply chain shifts we're seeing, is this a sustainable new normal for global trade? Or is it just a messy transition phase before even bigger, more fundamental changes have to happen? Something to think about. Want more insights like these? Join our MM Max subscription and get full access to our expert reports and in-depth market analysis.